In light of the lower net income forecast and the more conservative estimate, most of the companies are still rated as buy. We think much of the downside has been priced in, especially for MEG and FLI. So I'm going to be talking about the property sector, just a summary of what's happened and what we expect or think what will happen going forward in light of the current health crisis. So let's begin. So right now, most of Luzon or in other areas around the Philippines are in enhanced community lockdown. So during this enhanced community quarantine or ECQ, all construction and selling activities are halted. So this means showrooms are closed, sales offices are closed, companies are not allowed to work on their current projects. Also, malls are closed except for essential tenants like supermarkets, pharmacies, banks, hardware, and other restaurants that offer takeout and deliveries. So for most developers, they've waived the rent for tenants that are non-operating, except for SM Prime. They also waived for those that are operating, like the ones we talked about earlier. So it's their part, it's their way of giving back to the community or encouraging these operators to help out during this time of crisis. Next, for the office leasing, this should be more resilient during the lockdown as tenants are expected to continue paying rents. Though some are asking for deferral of payments, but that doesn't mean companies will be losing revenues. It just means they'll be receiving some of the rents later this year. So there's no lost rent, just some deferral of payments. For hotels and resort operations, it's going to be significantly lower as only in-city hotels are operational. Hotels are currently being used as temporary lodging for BPO employees and frontliners. But resorts are all closed, and other hotels that are not in central business districts, I don't think they're operating at a high level capacity. So how does this impact developers? So mall profits will decline because non-operating tenants are given rent holiday during the CCQ period, while expenses like payroll, utilities, and depreciation will continue to be incurred. For the residential segment, no revenues will be booked during the halt of construction activities, but variable costs of sales, which usually account for 70 to 80% of expenses, are also not incurred, slightly cushioning the bottom line impact on this segment. Companies say they continue to record some take-up sales during the ECQ as agents make use of online selling channels and companies have online facilities for receiving payments. But we expect this to be significantly lower compared to what we saw last year or what we normally see. So still on the residential segment, there has been no reported spike in defaults and backout rates yet because buyers are given 30-day leeway for payments if requested. And also for a company to tag a buyer as delinquent or maybe at default, they would have to be not paying for a few months. So we could see an increase in default and backout rates in the third quarter when we go back to a more normal state of operation and we see which buyers are actually not going to be able to pay because of their current financial situation and not just because of admin difficulties or not being able to go to the bank and pay for their monthly payments. No. So it's better to evaluate this after the ECQ. There were also reports that Chinese buyers are not paying, but As far as the companies we've talked to, they said this is not true, and they said Chinese buyers continue to pay on time. So that's a good news for us. So hotel segments are also going to be seeing lower income as not all hotels are operating, and occupancy rate of hotels outside the business districts are expected to be low. For offices, as we mentioned earlier, they will continue to book revenues as normal. Tenants are not given rent concession despite lower level of operations. However, some tenants are asking for deferral of rent payments during this ECQ period. But this does not mean lower revenues for companies. It just means that they'll be collecting rent payments at a later date. So for companies under our coverage, all of them are going to be negatively impacted because of what's happening or what's happened. But it varies based on their level of exposure to each segment. So right here we see the revenue breakdown for the developers under our coverage. So for Ali, they get most of their revenues from property development, which is sales of residential and office projects. For Meg, yeah, it's also property development. For SM Prime, it's mostly from the malls. RLC is also malls and property development. Vista Land is majority property development. For FLI, it's property development and offices. So this is the revenue breakdown. What we think is a more telling data in terms of seeing their exposure to each segment is the operating income, which we see in our next slide. So here we see which companies are negatively affected because of what's happening now. As we know, malls are closed during the ECQ, or majority of the tenants are not operating during the ECQ, and property development is also going to be heavily impacted because they're going to be halting construction, so no revenues will be booked in that area. And the most resilient segment will be the offices, as they continue to book revenues from rent. So here we see the breakdown of their varying levels of exposure based on each segment. So what we like is those that get more of their operating income from offices and less from malls and property development. So from here we see that FLI and MegaWorld are the ones that are relatively more exposed to the resilient office segment. FLI gets 40% of its operating income from offices, while Meg gets 36% from offices. What we think is going to be hit most because of the closure of malls is SM Prime and RLC. From this, we see that SM Prime gets 62% of its operating income from malls, while RLC gets 42%. Vista Land, we also expect it to take a big hit because of they're heavily exposed in the property development segment and the malls. So they get 74% of their income from property development and 20% of operating income from malls. Their exposure to office is just 6% now. So this is just more data on how mall operators are doing during the ECQ and their level of exposure. As we mentioned earlier, SM Prime did not receive any rent revenue during the ECQ because they waived the rent of tenants that are operating and non-operating. And they get like 62% of their operating income from the mall segment. So we expect them to take a big hit in the second quarter. So we saw a preview of how the ECQ impacted earnings of some of the developers. SM Prime, Ali, RLC, and FLI have reported first quarter earnings. SM Prime's earnings were down 5.5%, Ali declined 41%, FLI was down 24.8%. while RLC was up 82.4%. But we need to take note that RLC's growth was due to a lumpy revenue booking as a result of a change in revenue booking policy for its residential segment. So this is an exception to what's happening to the developers. So next, we're going to be talking about each segment and how they're affected. So residential segment takes a big hit. Ali's residential development segment was down 42.1%. FLI was down 39.5%. So this is a result of no construction during the last 15 days of the quarter. Plus, I think in the case of Ali and FLI, their projects are in the earlier stage of construction. So revenue booking is slower during this phase of construction. For RLC, as I mentioned earlier, their growth was due to a lumpy revenue booking as a result of change in booking policy for its residential segment. Before, they used to start booking when the buyers pay down 15%. Starting this year, they're gonna be booking revenues when buyers pay 10%. So in the first quarter of this year, we saw a lumpy revenue booking. This accounts for those that are paid between 14 to 10%. So last year, even if you're paid 14%, you're not going to start booking revenues. But starting this year, because it's above 10%, so they're going to be booking revenues for those projects that are paid between 10 to 14%. For SM Prime, they said they were able to increase completion of their projects, so they still managed to grow 22.8% in the first quarter, but we don't expect this to be sustainable given that construction is halted since March 15 in many parts of the Philippines. So on the demand side, residential sales was mixed again. SM Prime still booking 39% growth, RLC 4%, while Ali and FLI recorded declines in take-up sales. On the part of Ali and FLI, we think this is because of lower project launches in the first quarter compared to first quarter last year. And we also do not expect the growth of RLC and SM Prime to be sustainable going forward because of the ECQ, and not just that, but because we expect change in consumer behavior because of uncertainty with the economy, with their businesses and their income. So the mall segment suffered during the ECQ. For SM Prime, their revenues were down 24.6%. Ali was down 9%, RLC declined 8.5%, while FLI's small revenues were down 25.1%. As we mentioned earlier, Ali waived rents for tenants, even for those that are operating during the ECQ. That's why we saw a big decline in the first quarter results. For FLI, I think the mall in Tagaytay was also negatively impacted by the Taal volcano explosion in January. The office segment continues to be a bright side for developers. They continue to grow despite the ECQ. Ali still managed to grow their office leasing revenues by 15%. RLC's office leasing revenues were up 27.2%, while FLI was up 15.5%. For this 3.1% decline of SM Prime, this includes convention centers and hotels. But if we could isolate office leasing revenues, we believe they would have recorded a growth in the first quarter of this year. So why? Because no rents were waived for office tenants, even for POGOs, which were not allowed to operate during the ECQ. So growth came from higher leasable space compared to last year. So given that what's happened and what we expect to happen going forward, we decided to factor in the downside in revenues and net income in our forecast. So we revised our 2020 earnings forecast for all developers. So our new 2020 net income forecast reflects a significant decline for most developers, with SM Prime being hit the most because of their high exposure to malls and low exposure to the office segment. RLC, we see a 5% increase. Why? Because of what we mentioned earlier, the lumpy booking of residential revenues in the first quarter. Also, we expect them to book a big chunk of income from their Chengdu project, which was deferred from last year. That's why they're still expected to report a growth for this year. So one of the main concerns, aside from income, is the liquidity of these companies. Concern is whether they'll be able to pay their financial obligations and do they have ample liquidity to last this crisis. Most companies still have a manageable leverage ratio. As we see, net debt to equity is still all below 1, with MEG and RLC having the lowest. Also, maturing debt is still manageable. This one we're not very concerned about because we believe the financial system is still working properly and credit will not be very hard to come by for these large companies. As far as financial obligations or interest expense is concerned, we believe that operating income from malls and offices alone is enough to pay for their interest expense. Well, given that these are 2019 numbers, EBITDA from malls could be elevated compared to what we expect this year. But for most companies, EBITDA from offices are more than enough to pay for their interest expense. So we're not very much concerned about the liquidity of these developers. So in light of the lower net income forecast and the more conservative estimate in our valuation, we reduced our fair value estimate for all developers. But despite the lower fair value estimate, most of the companies are still rated as buy, with Ali and SM Prime being the only ones that are hold. As we see from this slide, this PE is implied PE based on our fair value estimate. So based on our fair value estimate, the implied PE is all of them are still lower than historical mean PE, while some of them are even lower than the -1 standard deviation historical PE. So that's why we think much of the downside has been priced into the market price, especially for MEG and FLI, which we think could be the more resilient ones given that they get much higher percent of their operating income from the office leasing segment, which is the more resilient segment in the current situation. So from this slide and going forward, we're going to be seeing the historical PE chart of all the developers under our coverage. So here we see Ali trading at -2 standard deviation below the historical mean. SM Prime a little above the mean, that's why we have a hold rating on SM Prime. RLC again below -1 standard deviation historical PE. Megaworld also, what we see here, still trading at historic lows. Vista Land, the same thing, and FLI. In summary, we think most segments of the property segment are going to be negatively affected, with only the office leasing segment being the more resilient one. So what we prefer are those that have a higher exposure to the office leasing segment. From the table we showed earlier, that's FLI and Megaworld. FLI gets, I think, 40% of their operating income from the office leasing segment, while Megaworld gets 36%. We're more cautious on the mall operators, not only because of the ECQ, but we also think that consumer behavior will change even after ECQ has been lifted.